there's no better indicator that we're coming to the end of the road on this great Keynesian experiment, or this what I call sovereign debt crisis, than the fact that gold is pressing to record highs every day. I mean, to me, that's a huge alarm bell going off.
Greetings and welcome to our show. My name is Trey Reik of Bristol Gold Group, and today we're conducting part 2 of our conversation with Larry Lepard, managing partner of Equity Management Associates in Wellesley, Massachusetts. Larry the Legend, as he is often called, is one of the most vocal and articulate champions of sound money in the contemporary investment landscape. Larry, thanks for your time in completing our conversation today.
Well, thank you, Trey, and thanks for having me back. I always enjoy our conversation. I just reread your most recent report on the gold market and found it fascinating as always. So a lot of good insights. I think we got a lot to talk about.
I agree. So as viewers may remember, Larry and I began our conversation in early Feb when Larry had just published his first full-length book called The Big Print. As we discussed, I found the book very accessible and chock full of facts and the history of what I like to call the modern era of unconventional central banking. But Larry, since that time, how's the book been received, and what have your experiences been around its release?
That's a great question, Trey. Thanks for asking. It seems to have gone reasonably well. I don't know what constitutes good sales. I'm kind of tracking around the 15,000 units sold level, which I guess is better than a lot of books, but still low compared to, we got a country of millions of people and we got a lot of people to educate about sound money. So, hopefully we'll sell a lot more and spread the word more, because I think, people need to protect themselves with gold and Bitcoin, as the book talks about.
We talked about this a little bit last time, and I noticed you've been very busy with interviews and podcasts on the book. But can you give us a 2-minute précis of what the book is about and why our viewers want to buy it?
Yeah, sure. So I wrote the book because I wanted to try to educate average Americans and citizens of the world, but obviously I live in America and I'm writing from an American perspective. I wanted to educate them on the issue of sound money and try to inform them that the reason that we have so much inflation, the reason that their lives are getting harder, the reason that there's monetary dysfunction is not greedy corporations. It is, in fact, the Federal Reserve and the system as constructed, where it must continually print money or else die. And sadly, that system has devolved in a bad way since 1971. And it's close, in my opinion, it's close to going critical now, as we see with gold hitting record highs. And so part 1 of the book is to try to explain so that somebody, even without a monetary background, somebody who just has a regular job and lives in America, can try and understand the things that you and I have known for some time, Trey, about the monetary system. So I try to keep the language simple. I try to put in footnotes to explain things. Like somebody read an early version and said, "What's the Federal Reserve?" I said, I better create a footnote for that. So, so the first part is, hey, here's why it's broken, and here's how you've been getting screwed by, the banking system and the Federal Reserve for all these years, and here's why your life is getting harder. And then the second part of the book is, here's the solution. You need to front run everybody else and get to forms of sound money that are, constituted in gold, silver, and Bitcoin. And I know not all your listeners believe in Bitcoin. That's fine. I mean, you don't have to believe in Bitcoin. Gold and silver are going to do just fine. But those 3 forms of money, in my opinion, or 2 forms of money, gold and silver, and Bitcoin is becoming a 3rd form. It's emerging. I think are the way to protect oneself from what I think is going to get worse. I mean, as you and I both know, the dollar's lost 97% of its value since 1971 in gold terms. And I think the last 3% is on the way. So the book is to try to help people to understand what's gone wrong, and then to try to suggest how they can protect themselves, because I think it's going to continue to go wrong.
Great. And I think it's fair to say that the largest conclusion of the book is that Bitcoin offers an interesting solution to the hard money conundrum that the world is facing. But we've talked about that. And what I'd like to focus on today is the role of gold and gold equities in your life.
Absolutely.
So just to kick things
I
off,
love gold, and I've always loved gold. I always will love gold. It's been money for 5,000 years.
right? So to kick things off, can you talk a bit about the disparate roles that Bitcoin and gold can play in an investment portfolio? Are Bitcoin and gold competing assets or complementary assets?
I actually think they're complementary. I like to think of the competing asset as fiat and the money that's printed by the governments. The way to get back to a sound money standard is to reject all of the fiat things, and so that's what gold people are doing, and that's what Bitcoin people are doing. And really, it's just the difference is just a matter of choice. I mean, if you're 80 or 90 years old and you don't want to suffer from high volatility, which is existent in Bitcoin, well, then gold is a great choice to protect you from monetary debasement, but it doesn't have as much alpha as Bitcoin. In turn, if you're young and you can live with the ups and downs and you're prepared to hodl through very difficult drawdowns, well, Bitcoin clearly has a bit more alpha and is outperforming gold because it's on an adoption curve. So whichever of those you choose or whatever the balance, and I have a lot of clients who are in both, and everybody's in both. I'm in both, and it's just you weight it based on your kind of volatility and risk preference and on your confidence in Bitcoin. I mean, I have a pretty high level of confidence in Bitcoin, but some people don't, and that's okay. I think everybody just makes their own choice. But I think, and so do they compete? Yes, I suppose at the margin. I actually thought about this a little bit with respect to gold stocks. I mean, as you and I both know, in the past, if you felt there was going to be rapid monetary debasement, the gold stocks were probably the best way to express a bet on that, right? Because they went up rapidly when gold went up. And I think a little of that's changed a bit. A little of that shine has been taken off of that because, in the olden days when we had that monetary debasement, 20 and 30-year-olds would buy gold stocks. And I think today, 20 and 30-year-olds aren't interested in gold stocks. They see the debasement and they prefer the Bitcoin choice. So I think there's a little bit of that going on, but let's not kid ourselves. I mean, gold is a huge market. It's almost 20 trillion. Bitcoin's only 2. So they're both big markets, and there's room for all of us in the same boat. What needs to happen really is that these things we need to return to a neutral reserve currency, as we talk about in the book. So, and we will. That process is happening as we speak.
Excellent. So today, I think gold is up about $30. I'm not looking at the screen. Seems to go up just about every day these days, no matter what's going on. So after being up 27% last year, we're up, I think, 19% year to date in 25. Yeah. So you're talking about a 2-year gain of 51%, which is pretty significant for something as large and established as gold. So the financial media is attributing gold's 2025 strength squarely to the physical movements of gold around the world to try to get in front of Trump tariffs. Do you buy that?
I don't buy it. I mean, there are a lot of physical movements going on. I'm not sure it's tariff related. It could be arguably trying to restock Fort Knox in case they audit it. I also think it's really.
Oh, come on. You don't really believe that.
Yeah, we all know it's there, right?
Oh my God! Yeah, so if they say it's there, it's there. It doesn't.
It's
really
there.
matter.
You're right. It's there. I tend to be a little more simplistic about it. I think it's just very wealthy people looking at the setup that we have with all the money printing and the debasement, looking at what happened in COVID and so forth, and saying to themselves, I've got too much wealth not to have some of it in gold. And there's $900 trillion of wealth out there, and the gold market's 20 trillion of it, and a lot of that's not even available because it's in central banks and museums. So call maybe the available gold market 5 trillion. Well, 900 trillion of wealth, 5 trillion of gold. I mean, all it takes is some fraction, maybe it's only 5 or 10% of that 900 to say, I'm worried about this money printing. I better get some gold. And so I think it's as simple as that's what's going on, in terms of shoving the price up. And, to me, Trey, there's no better indicator that we're coming to the end of the road on this great Keynesian experiment, or this, what I call sovereign debt crisis, than the fact that gold is pressing to record highs every day. I mean, to me, that's a huge alarm bell going off. So,
yeah. And not to put words in your mouth, but I sort of reduced, the strength in the past year to a 3-part argument. The U.S. deficit, anti-dollar sentiment around the world, and Fed credibility. So I like to say that those are the big three that
I
are
think that's right.
finally, we've been talking about them for 15, 20 years, but not to sound like we're talking our own book. There are inflection points where these things start to truly matter. Am I overstating it?
No, not at all. And I'm right in sync with you. I think those are the critical things. I mean, grabbing the Russian reserves told the rest of the world that, hey, maybe my dollar reserves aren't safe. I should trade in something else. The COVID expenses and the fact that we didn't reduce spending after the COVID expenses and that deficits blew out, and then just general central bank buying. And I think awareness of what I call the fiscal debt trap, which is to say, that even in spite of Doge, which I applaud and is a move in the right direction, I fear that it's just too little too late. We have too much government expenditure. And if Elon goes after that, expenses and tries to whack them back, the notion that he can take 2 trillion out is just, it's not realistic. He's being overly
Right.
optimistic. So given that means they'll have to sell more debt. Given they sell more debt, that means they put pressure on interest rates. And we've all seen the interest rate chart for the federal government, which is kind of going parabolic. And so, what's interesting to me, Trey, is that if you study history, this has happened before in many, many other countries. This is not some new phenomenon. Oh, government spends too much money, borrows to do it, prints money to pay the debt. Gee, that's unusual thing. No, it's not. I mean, take a lot of small developing countries, and we have, hundreds of, or certainly dozens of incidences of that. What's never happened before, what's happened in quite some time, is to have that happen with the biggest country in the world economically. I mean, arguably, and with the reserve currency, right? And so, if you do the same thing, I think you get the same result. Now, certainly with a lag, it's all held together much longer than I thought. And you and I have discussed this in the past. I thought 2008 might be the big one, but it wasn't. So, and they're, as we know, you and I both know, they're pretty good can kickers, and they're going to try and kick this can too. We'll see if they can. I think they're getting close to the end of can kicking ability, but we'll see.
Central banks get a lot of attention, and Goldman Sachs, as I'm sure you saw last week, put out a report. And the Goldman Sachs sort of angle on gold analysis, Lena, I think is the analyst's name. And, they have this sort of shadow system where the UK reports central bank gold transaction, but Switzerland does not. So they take UK exports, subtract Swiss imports, and they come up with an interpolated number, which they assume are unreported central bank purchases, which, since Goldman is probably handling most of the trades, we're going to have to go with it and say that's a very logical way to do it. And, they really emphasize central bank buying. Personally, I've always felt central banks, it's not really in their DNA to buy on upticks. And a lot of the big buyers buy from domestic producers like China and Russia. So I'm actually in your camp. You started this earlier. I actually think we've hit the point where a lot of this strength in the gold price is coming from pools of global wealth, sovereign wealth, family offices, etc. Maybe not in the West, but around the world. I really do believe that the migration to gold in those big pools of capital has started. Are you seeing any evidence of that?
No, just nothing other than the shipments and the things that I read on Twitter and in the press. I mean, but I think that's right. I mean, I do see a change in tone. And you mentioned the Goldman report, and I found it very funny. If you go to my Twitter feed, you'll read it. I loved it because Luke Groman retweeted, that Goldman report, and then right above it, he had the part in the Big Short where Michael Burry was complaining to the bankers that, oh, now that now you'll mark my CDS correctly now that you're on side. And he was like, okay, now we know all's clear. When Goldman Sachs is predicting higher gold prices, we know that they're now on side. So yeah, it's really something to watch. I mean, up 55% in 2 years. You have a better sense of the historical numbers than I do. I'm not sure we can point to, maybe except for the 77, 8, 9 run. I don't think
Mm,
we've seen a couple of years like this in a long time, right?
right.
Yeah.
Another factor that's been pointed out to me from some of my SCP colleagues is the Basel III implementation. So
Yeah.
we've been reading about Basel III for enough years that I sort of have dismissed it as not that important or never going to happen, but I guess it's going to be implemented in June. Have you heard or do you believe that banks may
Yeah,
actually?
I haven't, to be honest with you, I'm aware of that. I haven't focused much on it, but it makes gold, risk-free collateral, which I think is a positive thing. I mean, I think there are a lot of things behind the scenes, and Ronan Manley and some of the other guys on Twitter have done a better job, John's Newhouse and so forth, of laying this stuff out. But I mean, the fact that J.P. Morgan started being a custodian for all the GLD
Mhm,
stuff, I mean, that's interesting.
mhm, mhm,
There are a lot of little signs that it's starting to matter more to more and more people, and Basel III is certainly one of them. I think two other data points that I find interesting that others might as well. That Jay Powell recently started to taper the QT from 25 trillion a month of treasuries to 5 trillion a month of
right.
treasuries, and then
Yeah.
he, in fact, also said that maybe he would start to use some of the runoff in the MBS to repurchase the Treasury. So that's effectively QE. And then also, I think Scott Bessent floated the notion that maybe the SLR ratio, the supplementary leverage ratio that the banks have, might be waived, which again would allow the banks to buy more treasuries because the Treasury market is getting tight. And then there was some good stuff this weekend that I retweeted and that was on Zero Hedge. I'm sure you saw about this Brookings Institute paper where they floated the notion that the Fed ought to stand ready to step in and backstop the basis trade. And the basis trade is being used by the hedge funds
Right.
to purchase a lot of the short-term treasuries. And so
Mhm.
so we see signs around the side of the building that there's smoke starting to come out. And these are all signs. And then we see the gold price hitting record highs. And so these are all signs to me that, we're really in it right now. And we see the imports, and so forth. I mean, we're really in it right now. It's kind of game on. And, it wouldn't surprise me to see, something blow up in the next 3 to 6 months. And, somebody's on the wrong side of this,
Another thing about the
you know.
Basel III situation is it could be, not to be too conspiracy theory, but it could be that banks are starting to get a little nervous about gold as a tier one physical asset in the massive derivative books that are out there. So once it's another thing we've been reading about for decades, that was due for a comeuppance, but Basel III may be ushering that a little bit sooner than would have otherwise been the case.
Very possibly. I mean, those derivatives have always, scared the hell out of me. And you know, the title of my book alludes to the biggest tool or weapon that the Fed has, which is printing money. And we don't know how it's going to unfold. You never do, but we do know that mathematically, if you grow the debt faster than the underlying GDP, which services the debt, eventually a problem occurs. And so, I see signs of smoke coming out of the building. And I'm guessing there's a fire in there somewhere. When it'll get
So
full
for
fledged. Yeah.
for the average investor, I've always joked gold is one of those assets where the current price is never the right price. If it's rising rapidly, people think they missed it. If it's falling, there's no urgency, and people say "I told you so." And if it's not moving, nobody's interested. So, what do you say to investors who think they already missed it? We're at 3,100.
Yeah, that's a
Pretty
that's
hard
a
to
really
take a shot at gold at 3,100. So
yeah.
what advice can we give there?
Well, a couple things. One, you should, yeah, obviously it's the best time to plant a tree was a year ago, and the second best time is today. But
Hmm.
obviously dollar cost averaging isn't a bad way to go. I mean, I think it's important, to have a multi-year time frame, and gold is a little bit extended above its 200-day moving average now. So if I had a lot of gold I wanted to own, maybe I wouldn't buy it all now. Maybe I'd space out my buys over a year or two.
Hmm.
But on the other hand, the flip side of that is that this could be a nonlinear event. I mean, a la 2008. I mean, or an 87. I mean, people kind of assume that markets have a certain linear path, and as Taylor laid out with the fat tails thesis, occasionally they don't. And
The
so
proverbial hockey stick, right?
yeah, and and I'm not sure. The problem is I'm not sure if this is the one. None of us are, but here's another way of looking at it. I mean, it's like an avalanche. Which snowflake is going to cause it? Or as I've used this in the Bitcoin example, but it applies to gold too. So if the financial system and fiat currency is the Titanic, and owning some gold is a seat on the lifeboat, yeah, it would have been great to buy the seat in 2018 or 19 for $13.65, but now the seat costs $3,100. But do you want the seat or don't you? If the financial system is the Titanic. I mean, that's kind of the question. And I think everybody just has to probability weight. I mean, I would never suggest everybody go take all their assets and put them in gold. I mean, nobody knows what's going to happen. But as you and I both know, and I think you probably have some numbers and statistics, I think your recent letter talked about this. There's there are a lot of people who have zero exposure to gold or very light exposure to gold, and it's a great portfolio diversifier. So, yes, it feels expensive at 3,100, but guess what? It's going to seem cheap when it's at 9,000. So, if you don't have 5%, 10% or something allocated to it, there's never a bad time to buy it, kind of in my view. And with an eye toward, if it had a serious correction, you might want to add more, right? That's kind of how I see it, because I think the trend is that fiat will ultimately be massively debased and arguably even fail.
So there are lots of different methodologies for how to value gold. One of the most popular is sort of the shadow base money equivalent in terms of the Fed's balance sheet. Do you have a methodology for what is the proper way to imply gold's long-term
I
value?
do. I mean, I look at that same model, and there's actually a great chart done by Brent Johnson, Santiago Capital, in my book that kind of shows how much, look, in 1979-80, we were in a gold bubble. Gold went to 800. The gold on the Fed's, Treasury's balance sheet covered more than all of the dollars outstanding. If you did that same math today, to make those numbers balance, gold would have to be 80,000 an ounce, and it's at 3,100. So we're still, in my view, very much on our side of the ledger. But we could live on a gold standard without having 100% gold coverage, right? I mean, many gold standards existed and were successful with 40% coverage. So, but I can see a clear path to 5,000 or 10,000, and I expect that. I mean, I have a high degree of confidence that in this cycle we will see that. I mean, in the 70 cycle, we went from 35 to 800. Now, that started at a depressed rate because the 35 was kind of a non-market rate. So that was a 22x. But even in the 20 to 2011 cycle, we did a 9x. And if this cycle started at the bottom in December of 2015, which I believe it did, it was 1,050 at that time. So a 9x would take you to 9,000. So I see a very clear path to 5,000 to 10,000 gold. Beyond that, who knows? I mean, the book talks about this, and you and I have discussed this as well. There's just the issue of what's the next monetary system going to look like, and they'll probably try a lot of stupid shit before they figure out what the right thing to do is. And the right thing to do is to return to a sound money standard. So, but the zigs and zags between here and there are going to be tough, and that's the other thing I think people have to understand when they're in this category and in this asset class. Monetary systems failing are very volatile. There's a really good chart by Dan Oliver in the book that shows the volatility of the gold price in German marks during the Weimar hyperinflation. I mean, gold was clearly the right thing to hold if you were in Germany in 1919, because by 1923 the mark was worthless. But the gold price zigzagged a whole lot, and so it went up and it went down in mark terms. And if you panicked on one of those downturns, well, you lost your seat on the lifeboat. So, people, this is a tough trade, is I guess what I'm trying to say. And you don't want to get scared out of it. If you really believe, as I do, that inflation is a high probability and the monetary system is in deep shit, you want to make sure you hang on to your life insurance, which is your wealth insurance, which is gold.
So, over the decades, I have argued because gold bears like to point out that gold adjusted for the 1980 high, isn't necessarily that high. But my retort has always been there are decades to own gold and decades where it doesn't make a lot of sense.
That's
And in
exactly right.
January
Yeah, that's
1980, inflation was high, interest rates were high and falling, productivity was high, savings were high. And so gold really was
and
not,
debt was low, and
a
so
very,
that they were able. I mean, Reagan, through his deficits and his defense buildup to defeat the Soviet Union, was able to kind of
Mhm.
jumpstart a pretty healthy economy. I mean, we had some. If you go back and look at those Reagan years, I mean, everyone bitched about the deficits, but we had some really great growth. Through the 80s there under Reagan. I think one year we had 7% real growth. I mean, so yes, in when the monetary unit is sound and credit is expanding, gold sucks as an investment. And that was
So
true from
skipping ahead to
1980 all the way.
2000,
Yeah,
all,
go
all
ahead.
of those parameters were reversed. So here's my question.
Exactly.
How are we going to know when gold has done its thing? Like,
Well,
how will we know it's time to move away from the trade?
it's a great question. I'm going to count on Michael Oliver because he's really good technically, and he told me to get out of it in 2011, and I didn't. And I wish I'd listened to him, but
Hmm.
I'm half joking because that's just technical analysis. Look, I think when everybody's in it, when the shoe shine boy is talking about it, when the value is it covers the monetary system, and probably more importantly, when it really is clear that we have a new monetary system emerging that gold is a piece of, well then it'll just be the base layer of money, and a much more productive asset will be to buy something that produces things and grows, because as Buffett points out correctly, so the gold just sits in a vault. It's a goose that doesn't lay eggs, but
Hmm.
that's a very useful goose to have when the thing that lays eggs is printing money like crazy.
Hmm.
so
Right.
so I don't know. I think it'll be a geopolitical event, actually, Trey. I think we will realize that, what, they fixed the monetary problem. This is a good thing. We fixed it. We had to fix it. Inflation was just so bad, and but I envision that as kind of being from today. That's probably a 10-year project, and it
Right.
could be longer if they drag this thing out. I hope not, because I want to see it in
The
my
question
lifetime.
has clearly come to mind, will it be in our lifetimes? But
I
we'll
know it's a
skip that
question for sure.
consideration.
Yeah,
So moving on
yeah,
to gold equities, which is a
yeah.
matter close to our hearts,
It
what
is.
role do they play in an investment portfolio? And frankly, why are they worth the trouble?
Well, the second question, for some people they're not. I mean, and it is a very tough business, as you know, and there are a lot of bad gold equities and always have been, and so it's very important to separate the good from the bad. But what they do provide is, if you think about it, gold is an asset that doesn't produce anything. A gold equity, a stock, a company, defines a resource. It may have a multi-year life, sometimes 10 or 20 years. They build a plant and they're able to pull the resource out of the ground at a cost where the margin between the selling price and the cost to pull it out is substantial. In today's world, it's getting quite substantial. And that's a stream of cash flows going forward. And so now suddenly you have a company with a discounted where you can actually do a discounted cash flow analysis and say, if I knew this company was going to earn this amount for this many years, what would that equity be worth, in terms of dividends or other things? And so that's the gold equity thesis. And historically, gold equities have produced, kind of 2 to 3x the alpha of gold. So just as a rough number, say gold going up 10%, the gold equity should go up 20 or 30%, because they represent that stream. Now, within the equities, I don't know, maybe I'm front running your next question, but let me just say, because I think it's very important for people to understand this. There are all kinds of gold equities, many of which aren't so good. And in my opinion, the sweet spot in gold equity land is a company that actually has a mine. The mine is actually producing metal, and the metal is actually producing a good operating margin and therefore a profit. And
Right.
so the first thing about that company that you notice compared to many other gold companies, they do not need to raise money. They are cash generative. So that's kind of test number one that I apply. Test number two is, what are they doing with that cash? Are they smart capital allocators? Do they have mind number two? Does mind number two look economic? And can they apply that cash to growing their production and their revenue? And if the answer to that is yes, well, then you've got a growing producer. And that's the sweet spot, in my opinion, of the equity investment business. Now, there are other areas that have more upside, but they also have more downside. And those other equities would be the drill story category. These are people who do not have any production. They've got a resource and they're drilling it out and trying to prove that they have a lot of ounces, which then inherently will have value someday. And then the third bucket is the developers bucket, which is they've actually got a proven resource, a 43101 compliant resource, and they've done at least a PEA and sometimes a full feasibility study that shows, okay, if we've invested X in CapEx, we would get Y in production, which would lead to Z of profits. And X, Y, and Z are very squishy numbers that they can lie about, and you have to kind of do give yourself a lot of margin of error on. But these developers can really grow in value too, because some of them are quite low values, because they're not producing any ore yet. So that's kind of the story. And so the story is, if you do this right and you pick the right names, you can vastly outperform the underlying appreciation in the gold price.
So I developed a term I call negative survivorship bias. So, in most industries, you want to go with the biggest established companies because they're the least risky. But gold mining is one of the few industries where I think you want to avoid the top 10. So a lot of people buy GDX, and with all due respect to Van Eck, and that's a massive ETF. If I looked at the top 10 holdings, I'm not sure my conclusion would be to be long each of those top 10 holdings, given the challenges they face with reserve replacement, et cetera. So can you talk a little bit about how that impacts your view?
Yeah, that's a great point that you make. And I want to emphasize that. I mean, the thing to keep in mind about any gold mining company is that it is a wasting asset. Once the gold is mined, it's not there anymore. They need to find new gold. When you're a small company and you're mining 100 or 200,000 ounces, and you've got a fairly prospective deposit, it's not crazy to think that you could find, and replace your production every year. When you're, Barrick or Newmont and you're mining 5 million ounces a year, it's hard to add 5 million ounces of reserves every year. So, the bottom line is that you want to find companies that can replace what they mine in any given year in terms of prospectivity. And you're right. I mean, however, I will say this: there are some majors, not many, but I know which ones they are, and we'll mention one like Agnico. There are some majors and a few others around it. I'm not going to mention them that have done a pretty damn good job, and even in spite of their large size, are able to replace what they mine and add value and grow value within their company. Interestingly, the two largest miners in the U.S., which are kind of go-to names for hedge funds, Barrick and Newmont, they do not fall into that bucket, and I don't own either of them for that reason.
Mm-hmm. Yeah. So before we get into the stocks that you traffic in,
I've got a bunch of them.
Yeah. I have a more general question for you.
Sure.
Gold went up 12 years in a row from 2001 to 2012. I'm not aware of any other asset that has gone up 12 years in a row, literally in the history of financial markets. So management discipline, capital discipline completely eroded. Didn't matter what mistakes you made, you got bailed out. The gold price only went up. And we both know that led to massive misallocation of capital, capital write-offs. And I think about a peak to trough decline of about 85% in the sector, which, is going to be tough to ever recover from. But my question to you is, am I overstating things in saying that it's no longer justifiable for folks to look at the gold industry in whole as poorly managed and lacking capital discipline? Is it fair to say there's been some improvement on average?
I think there's been a ton of improvement on average, but I emphasize the on average, and I also emphasize that there's a large difference between the best and the worst. And so stock picking really does count. It's that whole experience, and I was in the market at that time from 8 to 11, and then I wrote it down that curve. So I suffered all those losses, which I'm ashamed of, but it is what it is. That curve educated a whole couple generations of gold stock managers, and to my way of seeing it, they've actually become almost too conservative now, Trey. I mean, if knowing what they know, sitting where they're sitting, spending what they're spending to drill and find replacements, replacement ounces. That looking around the landscape, surveying the landscape. If I were a Corp Fin or a CEO of one of those big companies, I'd be buying some of these smaller companies now when I can still get them at something that approaches cheap, as opposed to a year or two from now when they're going to double or triple in price, and I've got to pay a higher valuation for them. And sadly, all these industries are the same. They're kind of like sheep. I mean, right now they're still afraid. I mean, part of the reason I think the gold stocks. I mean, I don't have the chart to put up, but if you run a chart of the price of gold versus the price of the gold stocks, there's a really big disconnect, right? I mean, gold has gone up quite a bit, and the stocks have not they participated, but not nearly to the same degree. And I think that's because people are still feeling very burnt and very cautious about these stocks, and they really don't believe higher future gold prices, and arguably they've lost some trust in the management, etc. So, yeah, it's. But I think in general, management teams are much better than they were in 2011. And I think in general they've been much more conservative. Like I say, I kind of wish a few of them would be a little bit more aggressive,
Right.
because there's some good opportunities, right?
Right. So, and then the last sort of general question before we get into your portfolio.
Sure.
I always think it's important to share a disclaimer with folks, viewers who are building their own portfolios, that picking one or two gold stocks is a very bad idea.
Oh, terrible idea.
So,
Terrible.
what do you think? 5 to 10 minimum?